Welcome. Soon we'll be taking a closer look at profit planning for a business through cost, volume, profit analysis. And before we do that, we need to make sure you have a good understanding of the contribution margin income statement. Now, the contribution margin income statement does classify costs as variable or fixed and computes the contribution margin. If a cost is mixed, it will need to be broken into its variable or fixed components. By definition, the contribution margin is revenues minus variable costs, or sales minus variable costs. And this is the amount of sales that remain after variable expenses have been deducted. But another way to look at that is that it is the sales that remain that can go toward covering fixed costs and income. The contribution margin can be stated in three different ways and be meaningful. First, the total contribution margin is total sales minus total variable costs. This could be taken right off of a contribution margin income statement. The contribution margin per unit would be the unit selling price minus unit variable costs, since the definition of contribution margin is sales minus variable costs. Then you can calculate a ratio in one of two ways. You can do this on a per unit basis by taking contribution margin per unit divided by sales price per unit, or a total dollar basis, which is total contribution margin divided by total sales dollars. Now, the other thing that we need to look at is the variable cost ratio, which can be calculated in two different ways: total variable cost divided by total sales dollars, or unit variable cost divided by the unit sales price. In other words, this too can be computed on a per unit basis or a total dollar basis, and you should get the same answer. Now let's look at the two financial statement formats side by side. In your first accounting course, you learned the traditional format: sales minus cost of goods sold equal gross margin minus operating expenses is equal to income. You will note, though, that the cost of goods sold is made up entirely of product costs, and the operating expenses are made up of period costs. They would be your selling and administrative expenses. So this traditional format emphasizes the product period distinction. The contribution margin format takes sales minus variable cost equal contribution margin minus fixed cost is equal to income. Now, note that variable cost will include both product and period costs. Likewise, fixed costs will include both product and period costs. So this format emphasizes cost behavior, or the variable-fixed distinction. Now let's look at an example. Klein Manufacturing Corp is the exclusive producer of a product that is experiencing growth in sales. Assume the company is able to sell all units produced. This is a simplifying assumption we're going to make here as we initially cover the contribution margin, and we'll build on that later on in the course, where this is not always true. But for now, we'll hold this true. The company's revenues and expenses for last month are given below. So last month, we sold 4,000 units and sales were $100,000, variable cost of goods sold $32,000, variable selling expenses $8,000, so our total variable costs were $40,000, leaving a contribution margin of $60,000. Our fixed overhead was $10,000, fixed selling and administrative expense was $26,000, so net operating income is $24,000. So looking at this and knowing the definition of contribution margin is sales minus variable costs, you can see that definition play out. But notice also that that $60,000 is what remains after variable costs are covered, and it can go toward covering fixed cost and income. What is the contribution margin per unit, variable cost ratio, and contribution margin ratio? Remember that we were given this top part of the income statement So if we want to simply calculate the contribution margin per unit, we can take the $60,000 contribution margin and divide by 4,000 units, and we will get $15 per unit. So every unit sold contributes $15 toward fixed cost and income. The variable cost ratio, we will take our total variable cost of $40,000 and we'll divide by sales of $100,000. So this is going to give us a variable cost ratio of 40%. What this means is 40% of sales go toward covering variable costs. Now we'll calculate the contribution margin ratio, which is contribution margin divided by sales. Contribution margin in the information given is $60,000. Sales are $100,000. So the contribution margin ratio is 60%. Now when you look at this, what you've done is shown that your sales go 40% toward variable cost and 60% toward contribution margin. These will always be complements. In other words, they'll add up to 100%. So 100% of sales will go toward variable cost and contribution margin. Based on the contribution margin ratio, how much will profits increase if 40 additional units are produced and sold for $1,000? Now you could recompute the income statement. But the faster way to do it is to know that after the company covers all of its costs, every unit sold contributes $15 toward income. So the contribution margin is $15 per unit. We're going to sell an extra 40 units, so profit will go up $600. So you should be able to see why this is a meaningful number to management. Note that we do not get to keep the entire sales price. We just get to keep the contribution margin. And that's only after fixed costs are covered. Prepare an income statement for the month using the contribution margin format if 4,040 units are sold. So what we're going to prove is that profits will go up $600 because this is a 40 unit increase in sales. Now this is the original information that was given. In order to adjust our income statement for a higher level of sales, we will need the sales price per unit because our sales will not be $100,000, they'll be higher. But we can get our sales price per unit by taking the sales of $100,000 for 4,000 units to see that it's $25 per unit. Likewise, we need to do this for all of our variable costs. We can do this individually for the cost of goods sold, $32,000 for 4,000 units, says that variable cost of goods sold was $8 for each unit sold. Variable selling expenses can be computed by taking the $8,000 incurred to sell 4,000 units, or $2 per unit. We do not need to calculate a cost per unit for fixed costs because if you think about it, if you sell an extra 40 units, will you have additional factory rent? Will you pay additional salaries to your administrators? And the answer is no. The definition of a fixed cost says that within that relevant range of activity, this cost will not change in total. All right, with this information, a sales price of $25 and a total variable cost of $10 per unit, $8 product cost, $2 period cost, for a total of $10, we can make our calculations. Sales, $25 per unit times 4,040 units is $101,000. Variable costs will increase in direct proportion to activity. To determine the amounts, we can take $8 times 4,040 and $2 times 4,040 for the variable selling expenses. So variable cost of goods sold are $32,320. Variable selling expenses are $8,080. This leaves a contribution margin of $60,600. We can now subtract our fixed cost, which will not change in total because of the sale of an additional 40 units. Fixed overhead is $10,000 if we sell 4,000 units, and it's $10,000 if we sell 4,040 units. Fixed selling and administrative expense is $26,000 at both levels of activity. This will give us income of $24,600. So you will notice that income had been $24,000 when we sold 4,000 units. In question 2, we computed that income would go up by $600, and you can see that in fact income is $24,600. So the thing you should really pay attention to here is that you really are applying your cost definitions. Variable cost will increase in direct proportion to activity. Fixed cost will remain constant in total. What is the effect on contribution margin and income if variable selling expenses are increased to $3 per unit? So if you'll remember, the variable selling cost had been $2 per unit. Now it's going to $3. So when we look at the effect on the contribution margin, you know that the variable cost in total is going from $10 per unit to $11 per unit because the selling expenses are going from 2 to 3. This is going to give us a $14 contribution margin rather than $15. So this is going to decrease our contribution margin. Now I put numbers to this, but you should eventually be able to just think out in your head. An increase in variable cost will decrease the contribution margin. The effect on income, you could recompute the income statement, but it should be somewhat obvious that if costs increase, income is going to go down unless there's an offsetting increase in sales, which we weren't told that there is. So the effect on income is that it will also decrease. All right, this is the end of this example. Now this contribution margin format is really better suited for management decisions, and the reason is that it emphasizes cost behavior. It emphasizes that variable costs are going to increase or decrease with activity, whereas fixed costs are going to remain constant. And so we're going to be using this in several topics to come, so be sure to learn it well, do your assignments, and bring questions.